What is going on, guys? Welcome to another video of the Pbtrading theory series. Today's episode is on risk management, the shit that we all hate, because everyone wants to full port and stuff. When it's you versus you in the markets, you need to set yourself limitations and rules that you have to follow every single day, so you never break the system, right? We talked about winning systems in the last video. And one of those things that goes against a winning system is over risking, is revenge trading, taking more trades than you need to, even under risking. All these things are a huge factor of why you could either be break-even trader, why you could be just unprofitable in general. And so we're going to talk about all these things today. Let me just start by saying, if you don't get in the habit of following your rules and finding a number that you're comfortable risking every day where you're not emotionally attached to the outcome of the trade, you will struggle a lot with trading. And it's a trial and error process, right? There's a point in trading where as you're trying to become better and I guess improve your psychology, you start with a number. You also just start with getting in the habit of getting into trades and trying to sit on your hands, not really interacting with what's happening. There's a portion where, let's say you up your risk and now you're trying to become more comfortable with that number. Let's say you're at a point where, you have gotten some payouts or you've started making money with trading and now you're increasing your capital, your allocation, you're increasing your risk maybe because you have a bigger buffer now. And it's, imperative that throughout all these times, you don't let your emotions override your logic. Because behind every trade, there's a story, and behind your risk, there's a purpose. Damn, I look fucking fried. And there's this like a stigma, or I don't know what to call it, around trading, where people are under the impression that the less you risk, the less risk you have on the table, the smarter that you are going about things. But the reality is, just because you dropped your risk from 1% to 0.1%, and now you can risk comfortably and you can go into trades comfortably, that doesn't necessarily make it smart, right? There does need to be a golden mean between what you do, like a happy medium, where you do feel like you're putting the appropriate risk on the table to see the long-term success that you want, but at the same time, not so much to the point where you literally want to crawl into the screen and just stop the trade from moving. Remember, the markets are going to do whatever the fuck they want. If they're going to stop you out, they're going to stop you out. If your trade's going to play out, it's going to play out. And it's all based on probability, how much probability you were able to stack in your favor. And even the winning trades are going to fail. But what you need to understand is that you don't react emotionally when a trade fails. It just means you had to lose in order to keep winning, according to statistics. And that's the only way you should be thinking about it. But there's more than just psychology to risk management. There's technicals behind it, right? And I'll get into that as well. People don't say, oh, one trade a day for no reason. You know what I mean? There's actual technicals behind it to support that idea, why it would be less probable the more trades you take throughout the day. Once again, since I know you guys are watching this video because you want to learn my style of trading, I will teach you my style of trading and how I see things and how I think you should risk. So of course, starting off with risk management. One trade a day is the ultimate key to profitability. This is literally the easiest way to not be break even and to not be unprofitable. This is such a not only digestible way to just like go about the markets, where if you take a win, it's easy to just be like, okay, I'm done. If you take a loss, it's only one loss. It's also just the most convenient way. Like, you don't want to be on the charts looking for trade after trade after trade. You want to just execute and call it a day. Do what you have to do, find your setup, and then go on with the rest of your day. You don't have to stick around for the rest of the session if you already did what you had to do, right? That's the beauty of it. You're not stuck in a fucking cubicle doing more tasks just because you have more time to kill. That's not how trading works. That's counterintuitive. You want to utilize your time freedom, your locational freedom. So that being said, let's go into it, right? One trade a day is crucial. Also, I'm a firm believer that 1% risk is the perfect number, right? 1% risk to me is the perfect number. Most prop firms will give you around, they'll give you around 4 to 6% on the account to lose, right? And with a 70% win rate strategy, you are far more likely to get the winning side of the statistic and pass the evaluation in not that much time. 1% risk is a beautiful number. It's very unlikely that you'll lose 4 trades in a row and blow the account, but it is possible. Everything is possible with trading. But anyways, 1% risk, perfect, right? If 1% feels like a lot and you're someone who's newer and you feel like you need to get more reps in without having to risk 1% quite yet because you don't find yourself to be completely convicted in a model and you're still lacking conviction and the ability to execute well, then maybe 0.5% risk. But for those of you who are watching and you want to start building that comfortability, trading a number that is actually viable, very sustainable, and, you know, just overall optimal for evaluation accounts, prop firms, whatever, live trading. So if you're trading a 50K funded account, that's $500. If you're trading in a 100K funded account, that's $1,000, 150K, 1,500. You get the point. So 1 trade a day, 1% risk, 1 session. 1. It's annoying, but it's true. Like I said, the more sessions you trade, the more trades you take. It's counterintuitive. It doesn't make sense. You're no longer trading for freedom. You're just a slave to the charts at this point. And so I can't emphasize this enough, right? I can go on about this forever, but this is very important. Now, the question that everyone asks, should I trade minis or micros? How many contracts should I trade if I'm on a 50K? That varies. 1 mini equals 10 micros, right? So 1 mini holds the weight of 10 micros. Oh shit. And I'll show you sort of how you can go about it, right? Let's grab this trade from Tuesday, for example. Let's say we're taking longs here on Tuesday, right? Off this inversion to the upside. I would whip out my position tool. First thing I would do is whip out my position tool. Before the candle even inverses, I'm already calculating approximately how many points my stop loss is going to be. And obviously whatever, TP is wherever it's convenient. We don't take profits on just an ideal RR, like, oh, we want 1 to 2 RR, we want 1 to 1 RR. There's a story behind everything that we're doing, right? We're taking profits at levels that we expect rejection and all that. And that's also crucial to being profitable. You actually have a reason behind everything. That's why you're not tripping out when your stop loss is where it's at, because if you're right, it should hit your TP. And if you're wrong, it will run your stop loss, but whatever. If you follow your rules, everything that happens in between shouldn't matter. If it wants to accumulate around here for a while and then go to TP, you know, that happens. If it wants to rip to your TP in 1 second, that can happen. If it wants to stop you out in 1 second, that can happen. Doesn't matter. The point is that you understand risk management. The way I like to see it is, it's very simple for me. I'll show you the way I calculate it. And I don't know if this is like the traditional way to calculate it, but if I zoom in, well, not zoom in, but if I look at the template chart here and I see that in the bottom, I have 33 points, 134 ticks. For every 100 ticks, well, like this number, you pretty much just add a 0. This is how I do it. It sounds very stupid, but it's the easiest way for me to calculate. And I'll show you really quick. I would be risking, well, in this case, I'm risking 29 points, 117. My stop loss is always at the bottom of the manipulation leg at which I'm trading. And if I drag my stop loss down, notice what it's going to say. It's going to say 117, right? 117 on the right. Why? Because 2 minis is always going to equal to this number right here, just with an extra 0. So here, I'm not risking 117, I'm risking 1,170. And if I was risking 1 mini here, then I can just approximate half of this, which would be, you know, $585. I think that's what it would be, right? And then take profits. Well, take profits, you don't care. You're not basing it off RR here. You're basing it off where the next level is that you're targeting. So whatever I'm targeting here is going to be how much money I make, and that varies. But yeah, so an easy way to do it, I guess for those of you who don't understand what I'm saying here, is let's say your stop loss is around 25 points. Now with 25 points stop loss, well, 25 point risk, let's just call it, you are risking with one mini, this equals, with two minis, it equals $1,000. With micros, it's 1/10 of both of these. So this would be $50. Two micros would be $100. There's no reason that it should have taken me that long to find on the keyboard. And so when people say, how many minis or micros should I be risking every time? Well, it varies, right? And so let's say this is the formula for 25% risk. And then we create one for approximately 50. And this should just be in your head. This should just be in your head, right? 50 would be double all this. So this would be 1,000. One mini would be 1,000. Two minis would be 2,000. This would be 100. And this should be 200. And this is all for 50 points. And so now I have a general idea of what 25 point risk looks like with one mini, with two minis, with one micro, with two micros. What a 50 point risk stop loss would look like with one mini, with two minis, with one micro, with two micros, two micros. Wait, one micros? No, one micro. Micro. No plural there. And just with that information in my head, right, I'm able to quickly calculate and approximate how much I should be risking. So let's say I'm someone who wants to risk $500 per trade, and I pull out this template as this candle's inversing, and I'm right here, right? I'm trying to see, okay, it's a little bit over 25 points, which 25 points, one mini would usually give me 500. 1/10 of this, it would probably be 8 micros to get closer to 500 instead of 10 micros, because 10 micros is one mini. So here, if I know I'm at 30 points, I know that if I risk one mini, it's going to be more than 500. So I'm going to go to micros to get a more approximate, to get a more accurate number, and just assume, oh, well, I'll take a little bit off 10 micros so I can get about $800. And so here I would just do something like 8 micros, right? And so I just approximate that in my head. It shouldn't take me long. Now let's grab like a short up here, for example. This short, what is it? This is going to be a 50 point stop loss, right? Let's say we're taking an inverse here. This is about a 50 point stop loss, 55 if you want to be exact. So what do I know? Well, with 50 point stop loss, if I want to risk $500, in this case, I would just go to micros. And what would I do? In this case, I would risk, well, if it's a 50 point stop loss and 2 micros equals $200, then here I would just go about 4 micros, right? 4 micros should give me almost exactly $500. And so you see how I do like these approximates in my head to do these calculations? It's very, very easy. And so it's never a set contract size. Your contracts vary with stop loss size and such. And should you avoid a trade because one day your stop loss because one setup has a stop loss of 60 points, while your normal ones are the ones you're used to, who usually have like 20, 30 points. No, you should still take that trade. All that tells you is that the market has more volatility that day. There's going to be days where the market is printing 20, 30 point candles like nothing, even 100 point candles like it's nothing. Obviously that's probably a bit too much, but you should adapt always, right? Just because you're used to trading a stop loss of this size doesn't mean you should avoid a trade of this size. You just have to change your contract size, and you can risk the same amount. And so it's super important that you understand this, right? And so you can go approximating as you go, obviously. But I would say these are the two most, like, I guess, efficient ways to think about it in your head quickly. And for those of you who are a bit heavier riskers, the easiest way is the 2 mini method in my head. Like, I always just look at this number and I see, okay, 120, 2 minis would mean 1,200 here. And if I want to risk half of that, it would be, $600 with one mini. But I always just use this middle number as reference, and I calculate what 2 minis would be with it. Well, I don't calculate, I just add a 0. So 2 minis is 1,200 here. So one mini would be 600. That's kind of how I think about it. But everyone's different about things. Now, let's go into the technical reason why it's important that you understand one trade a day, right? Because there's more to one trade a day than it just being a psychological thing. It's not like, oh, take one trade a day because then you revenge trade and shit like that. No, that's not why. It's because whenever the market meets an objective, let's say you take a trade and the trade plays out, right? Why is it so crucial that after a winning trade you should get off the charts? Because usually after an objective has been met, then that implies that the market has distributed. It has distributed to another level. And now what can you anticipate after distribution? Accumulation. Prime example of this. Today I took a bit of a technical trade in a sense. I took this 30-second inversion, right? I wanted to target this major high up here. As discussed in the liquidity video, if you haven't watched, there was an SMT at this low, right? So we had an SMT at this low. Cool. Right, if you look at ES, SMT at the low, we tapped into what? On NQ, we had tapped into this 15-minute gap and also swept out the low inside of it. If you watch the liquidity video, you know why these moves are so powerful, right? So we have that SMT at the low as well, at the internal low, which is nice. And we have ES sweeping out these 5-minute intermediate lows. That gives me a lot of confidence. Liquidity sweeps inside of fair value gaps. And then I just took this 30-second right here to the upside, and I was targeting the major high, right? Targeting the major high. This is a bit of a discretionary trade. I was just doing this as part of the challenge series, but the main focus here is on the stop loss, right? So anyways, let's start off with the stop loss. First thing I check is, okay, my stop loss is going to be at this low, which if I look right here, it's 109 ticks or 27 points. We know that 25 points is what? Well, if it's one mini, it's $500. And if it's two minis, it's $1,000, right? With 25 points. And we know that we're sitting just about 25 points, 27. So a little bit over 25. So for those of you who want exact risk, right? Maybe you would be thinking here, well, I don't want to risk one mini for $500 because it's going to be a little over 500. So let me do 9 micros, right? And that will get me approximately $500 very accurately. For those of you who want to risk $2,000, right? I mean, $1,000. You'd be thinking, 2 minis is perfect here because 2 minis and 25 points equals $1,000 or something like that, and whatever. But now let's talk about the technical reason. So price had manipulated lower, right? It had manipulated lower. We had swept out those intermediate lows that I was talking about on like the 5 and 15-minute chart, which is the previous video I made on liquidity. And after we took this out, right, we started getting a nice reaction. So what happens after manipulation? Price distributes. And so as you can see, price distributes here, hits this high. And now what happens? Now what happens after price distributes to a certain level? Now an objective has been met. So why would I want to stay off the charts now? It's not just because, oh, one trade a day, like it's good for my psychology. It's not just like, oh, one trade a day, it's good for my psychology. Like, no. There's a literal technical reason, because you're going to see, let's say you go ahead and decide to take another long now off this inversion. What's going to happen? Well, we just had distribution. We just had price deliver very strongly. So am I going to anticipate that the second setup will play out just as well? Probably not, because what happens after distribution? Price accumulates. So then you enter this trade and price starts chopping around for a freaking boatload of time. And this happens a lot. Right? This happens all the time in the markets where people take one setup and they think that just because they won the first trade of the day, that it would make sense to take more because they're on like a hot streak and they can just risk more now. They're on a roll. That's not how it works. And this is also why it's important to be reactive to the market. You can't just watch 2 setups that you liked play out in front of you and then decide, oh, I'm going to take the third one. No, it's not just logically stupid. The market is not in your favor as much anymore because objectives have already been met. Now, under the circumstance where, let's say you go to take a trade and let's say we left this high above. Let's say we left that high. We never swept that high. And we just got, we went in longs and then price stopped us out. And, we still left our target above. Well, in that case, you're still bouncing off the same key level. You still have all the same confluences and you still have the same target. So if you would want to re-enter and give it another shot, that's for you to decide and calculate if, you know, it's worth the risk. And if you would be okay risking that, if your account can handle that for potential re-entry. But those are the times where re-entries are justifiable, where your target is still intact. You just got stop rated, but you're still holding the same key levels and everything. You just unfortunately got stop rated, which happens. You know, it happens pretty often. And so, yeah, obviously in this case, this is not an example of that because price did deliver and met an objective. And so after that, you're not going to just retake this long or take the second setup that presents itself that is the same one as this one, but this one had already completed this objective. So this one's less likely to play out, right? So that's really the technical reason behind it as well. And stick with one session because one session is going to help you really determine your win rate and overall help just get more accurate data on how you trade and perform. And then 1% risk is what I normally recommend people do, especially those who trade funded accounts. You don't want to be the person who's stuck on a funded account for months, bro, because you under risk like crazy and you're just getting rebuild after rebuild after rebuild. You know, you want to be not aggressive with it, but you want to risk what you should be risking, because when you're trading a 70% win rate strategy, that means obviously 7 out of 10 times you're winning, and the chances of you losing 4 trades in a row with a 70% win rate, I don't know what that is. It's very unlikely, but let me ask ChatGPT. Hey, if something has a 70% success rate, what are the chances of it failing 4 times in a row?
All right, so if something has a 70% success rate, that means it has a 30% chance of failing each time. So to figure out the chance of it failing 4 times in a row, you just take that 30% failure probability.
Multiply by 30, multiply by 30, multiply by... Sorry, I didn't mean to cut you off. Keep going.
No worries at all. Exactly, you've got it. So you're basically doing 0.3 times 0.3 times 0.3 times 0.3. That works out to about 0.001 or roughly 0.8%. So there's less than a 1% chance it would fail all 4 times in a row.
So you heard it. It's around less than a 1% chance that you would lose 4 times in a row. Obviously, that seems relatively inaccurate. With trading, it's a bit more likely because it's not as, I guess, mechanical. There's human error involved. There's unpredictable market conditions that can arise. And we're not just trading 10 times in an entire year. We are trading, you know, many times. So there could be a period where you win 20 trades in a row, which I had happen in January. I had happen last August and July, you know, where I go on these crazy win streaks. Jesus. And then after that, it follows with a small losing period, or I'll be on like a 10 trade winning streak, 20 trade winning streak, and then I'll lose like 7 trades in a row. And I'm like, oh fuck, you know what I mean? But that's natural because statistically that makes sense. Since I just had so many wins, it's almost inevitable that it gets balanced out. But anyways, we'll put here, I'd say ChatGPT said it's a less than 1% chance of you losing 4 trades in a row. I'd say it's a 10% chance. Does that mean that the only way to lose an account is losing 4 trades in a row? No, you can lose it in 1 trade or 2 trades if you full port. You can also lose it if you're just still getting used to a model and you're still unprofitable and you don't necessarily have the 70% win rate on live markets, right? You can still lose it if that's the case. You know, you win 1 trade but then lose 2, and then you win 1 trade and then you lose 2, and then, like, you know, now you lost the account. But that's how it goes. And as you get better, obviously you learn to mitigate those unnecessary losses. You learn to refine your edge, and you learn to be more consistent, and you become more profitable, of course. But the easiest way to do this is literally following that 3-step method. 1 trade a day, 1% risk, 1 session. It is almost impossible, if you know what you're doing as far as strategy, that this doesn't work in your favor. So yeah, that's my take on risk management. Hopefully you guys liked this video. Also remember, no risk, no Rari. That's just the reality. You know, you can't just trade like a little bitch and risk a dollar amount that is so unlikely to actually have an impact. You spending a lot of time on one account. Time is also money, and you can't treat trading like it's the safest, necessarily most as if you have all the time in the world to just sit there and watch an account grow trading $10 a day. You want to actually take initiative to grow, to build your account, to put yourself out of your comfort zone, but while also not over leveraging, not necessarily like destroying your mental health by putting more on the table than you can, mentally afford. Hopefully this video helped you one way or another, and I'll see you guys in the next video. Recommend this series to your friends. I really want the series to do well. I feel like a lot of people would benefit a ton from watching this. So yeah, much love, guys. Oh fuck, I gotta do the outro. What song did you guys request, bro? No way. Someone requested Pool House by Backseat Lovers. That's my jam. That's my jam. What the fuck you know about Backseat Lovers? Waiting around for something to change my mood, 'cause I know that I was doing the outro for the fucking video. This guy, bro, thinks he can just walk in here whenever. Waiting around for something to change my mood, 'cause I know that Watson's plastic cup isn't going to. The kids on the lawn stuck in pairs of two. Your lunch is on its way back up, but you're still in the pool. Wait inside, I'll be fine. Guess I'll sit outside while you change your mind. I skedaddle to a place where I get Nani-san, bugger.